So to start, I want to thank everyone on the board for being here and helping us through this learning experience, as well as professors in attendance as well. My name is Jackson Welsh.
Tony DiPiazza. I'm Josh Frederick. And I'm Will Schlingman. And for our project, we decided to reassess Spellman Fund's holding of Adobe. So to begin, we'll go over an overview of the business and the revenue streams, as well as their financials. Then we'll look at the key growth drivers we identified, the first being Creative Cloud and the second being Document Cloud. And then we'll go over our valuation, along with the risks we've identified, the portfolio fit and recommendation, and then a summary to finish it off for you guys. So to start, the Spellman Fund initially invested in Adobe in the fall of 2017 for 30 shares at the price of $197.31. And that has grown to a current weight of 3.14% of the current portfolio. And we are recommending a sell of all 30 shares at yesterday's close price was $400.85. This would lead to a return of 103% with a profit of $6,106. We believe this because growth stocks are overrepresented in the fund, with 46.9% of the fund being comprised of growth stocks compared to 40.4% being in the S&P 500. We think this is especially important because of the looming recession. And so to go over this again, we believe that we should sell all 30 shares of Adobe to lock in the profits that we have seen over the last 5 years. Also because it's overweighted in growth stocks, as well as we believe that the money would be allocated elsewhere, as you'll see with our valuation. So our valuation price was $414, and the current price is $400. So that is roughly a 3.5% return that we're projecting. So we don't believe that that is worth it. And then, so looking at their business, it is a subscription-based model, which leads to the challenges of obtaining new customers in existing markets. So they've already cornered the U.S. Market. So how many more people are you going to be able to sell Adobe to? As well as there's low barriers to entry, because theoretically anyone with a coding background can create a software that rivals Adobe. Along with some opportunities are that it's easy to enter new markets. So they have a very high market share in the United States and other markets, but like as they enter new markets, we would expect that to be the same. The key drivers we identified, as stated before, are Creative Cloud and Document Cloud, which combine to make their largest market segment being digital media, which accounts for 72.5% of their total revenue. And then when we look at the risks, we've looked at the Russia-Ukraine with conflict that could dampen revenue moving forward, as well as they've never seen a recession with their current business model, as in subscription. It was prepackaged software in the 2008 recession, so we don't believe that that data is relevant. And then we also have a concern with the interest rate and inflation that will be moving forward. So now looking at some key statistics of Adobe, to point out first, so in 2021, you can see that they have a high PE, and that's because of the COVID-19 rebound at the end of the year. So we don't believe that that is too much of a concern. It's more of an outlier. So looking at the trailing 12 months numbers, so it hovers around what 40 to 50%, or 40 to 50 in the recent years. So the 44 is right in line with that. And their net profit margin of roughly 30% is also historically accurate. But looking in 2020, the 40.88, that is also an outlier that Tony will touch on later during the presentation. And then they're sitting with a 10.1 EPS currently. Now I'll pass it off to Jackson to go over the business overview.
Yeah, so looking at the business overview of Adobe, Adobe is a computer software company specializing in the innovation of the digital experience. One of the main ways they kind of offer this innovation of the digital experience is through their digital media segment. Now, this digital media segment, as Will mentioned before, is broken up into two different categories. The first one being Creative Cloud, which generates the majority of Adobe's revenue at 60%. Along with that, they have a 12.5% 5-year growth rate. Now, that other category under the digital media segment is Document Cloud. Document Cloud has generates 12.5% of Adobe's revenue and has just over an 8% 5-year growth rate. Now, looking at figure 2 on the right side of your screen is the revenue by segment, and this is in millions. As you can see, digital media is far and above the biggest revenue generator for Adobe. Now, moving on to the next slide, you look at the revenue streams of Adobe. We compared the 2020 and the 2021 revenue streams, and as you can see in these two pie charts, they are very, very similar. Right away, Creative Cloud, as I mentioned, catches your eye at 60%. It is the majority of Adobe's revenue. Now, the product offerings under Creative Cloud would be their Photoshop, their Premiere Pro, stuff of that nature. Next is the other part of the digital media segment, which is Document Cloud. That's Adobe's Acrobat. You can see in 2020, it had a 12% revenue share, and then it increased 1% to 13% revenue share in 2021. Next, we have the digital experience. Now, this would be their marketing analytics software, and it covers 24% of Adobe's revenue. Finally, we have the smallest in the publishing and advertising segment of their revenue, and it did decrease from 4% in 2020 to 3% in 2021. Just do note that Adobe is looking to kind of phase this out over time and focus on their major 3 revenue streams. Now, looking at Adobe's ESG, some of the pros is that they achieved pay parity between men and women in 2018, and they still achieve pay parity today. That's something they're very proud of and something they market. Also, they have a very diverse board of directors. They have 12 members on their board. They are mostly independent, and they have 8 male, 4 female board members that come from a very, very diverse set of backgrounds, races, ethnicity. So they do have a very diverse board of directors. Some of the cons is that they fail to sell and promote more clean tech product lines. So these clean tech product lines would just be very energy efficient technology software. It's not that they do an awful job at this, it's just compared to competitors, they don't do as well in selling and promoting. Overall, Adobe's innovation helps lead to cloud-based software delivery, paperless workflows, and virtual collaboration, all things that positively benefit their ESG. So overall, we rate Adobe favorably based on their ESG. Next, I will pass it off to Tony to discuss Adobe's financials.
All right, so looking at Adobe's financials, I think it's important to note that the software industry is a very differentiated industry. So it's hard to compare Adobe directly to Oracle or IBM that's on the screen because the product offerings that they have are never the same as the next competitor. So we want to compare all of our averages, all of our financial ratios to the industry averages. Starting off with the PE ratio and the price to book ratio. These are both above the industry averages. PE is high at 44, which is about 3 times the market average. And we believe that this indicates that Adobe may be a growth stock. And the policy statement for the Spellman Fund states that we are value investors, so we should be allocating more of our money towards value stocks rather than growth stocks. And that's something we want to stress throughout this entire presentation. Next, looking at the profit margins. The software industry as a whole has high profit margins as they don't have inventory costs. So when comparing them to the industry average, they are slightly below. And one thing that I wanted to point out that we mentioned before is that in 2020, they had a net profit margin of above 40%. And we couldn't find the exact details about it, but this is from deferred tax assets that were recognized in this fiscal year. And next, I'm going to pass it back off to Will, who's going to talk about our first growth driver with Creative Cloud.
So as Tony said, I'll be talking about the Creative Cloud driver. So the apps within the Creative Cloud, also as Jackson said before, are Photoshop, Illustrator, and Premiere Pro, which are pretty much the 3 that you would think of for, that's what they market. So this makes up 60% of their total revenue. And we identified 2 main areas of growth, or 2 main spots of growth for them is the computer career growth rate in the United States is expected to be 12.5% year over year, which was found using the US Bureau of Labor Statistics. And then also their price growth is expected to be 5.7%, which is based on previous year's price increases. So when looking at the table, we're going to be multiplying the number of subscribers by 12.5%, which is the computer careers growth rate, and then the average revenue per subscriber by the 5.7% to give us our revenue for Creative Cloud, and then taking that by our net profit margin of 30.55. Adobe does not offer their segmented profit margins broken down, so this is just the firm. So it will be for both driver 1 and driver 2. And then when looking at their optimistic growth, we decided that, like, what if computer careers growth is higher than 12.5%, so we bumped that up to 16% and kept the other 2 constant. So the only number that would be different, or the number of subscribers is multiplied by 16%, which gives us our new Creative Cloud net incomes at the bottom. And then for pessimistic growth, we've decided to focus on the Russia-Ukraine conflict and their profit margin. So the EMEA makes up about 27% of Adobe's business, along with the World Bank is predicting a shrink in the European economy of 4.1%. So we multiplied those numbers together to get a 1.1% shrink in Adobe's business. And then there also, as stated before, there aren't like there is not very much findings on subscriber loss for Adobe during a recession. But we looked at Amazon Prime, Spotify, Hulu, and Netflix, and they do not really previously have any loss of subscribers. And go back. And then so for the net profit margin, we will be using the lowest net profit margin over the last 5 years. So for the number of subscribers, we're multiplying it by the 11.4, which is the 12.5 minus the 1.1 from the Russia-Ukraine impact. The price growth will stay the same because that we deem to be fit. And then we'll be using the net profit margin of 26.4, which was our lowest over the last 5 years to get our new pessimistic net income. Now I'll be passing off to Jackson for driver number 2.
Yeah, so looking at our second driver, which is Document Cloud, as Will mentioned. Document Cloud is the world's leading PDF and electronic signature solution. So you can store, you can share, connect your PDFs from anywhere with anyone. When you think of PDF, you think of Adobe, you think of Document Cloud. So as I mentioned before, Document Cloud makes up 12.5% of Adobe's total revenue. For opportunities for growth, we kind of analyzed the growth in the global PC market, and that is expected to be just over 8% year over year. So now looking at the baseline of Adobe, we took their number of subscribers and grew it by the just over 8% world PC growth, as I mentioned before. And we took our average revenue per subscriber, increased it by the price increase to get our revenue for Document Cloud. Took the net profit margin, as Will mentioned before, is their net profit margin as a whole, 30% to get our net income for Document Cloud. Moving on to the optimistic growth of Document Cloud. We increased their PC growth, as it is the optimistic growth scenario, to increase their number of subscribers. We did keep their price growth and net profit margin the same to get our optimistic Document Cloud net income. And finally, looking at our pessimistic growth, as Will mentioned earlier, we did include the Russia-Ukraine impact from this, and we decreased our growth rate by just over 1%. So we multiplied that by our number of subscribers, and then our average revenue, again, per subscriber times the price growth. And then we did take our 5-year low of profit margin to get our pessimistic growth scenario Document Cloud net income. So next, I will be passing it off to Josh to discuss our valuation of Adobe.
All right, so these are our baseline EPS valuation for the company. So first thing I'd like to note is that we broke down Creative Cloud and Document Cloud out of the digital media segment to be able to give you guys a visual impact of what Creative Cloud and Document Cloud actually provide to the company. Digital media is projected in our 2022 projections to be about 75% weight of total earnings for the company, going all the way up to 79% in 2025. Digital experience, they're growing at a pretty constant rate throughout our projections, but still losing weight in earnings to digital media. For publishing advertising, something that Jackson mentioned before, that they're trying to actively get out of this segment of the company. So we're seeing a decrease of about 2.5% there. But overall across the board, seeing a decrease. For our total EPS numbers for 2022, we're seeing about $11.65 for 2022, and then leading up to $18.18 for 2025. So for our growth rates, Creative Cloud and Document Cloud, Will and Jackson just touched on to be able to get those numbers, but combining those into the digital media growth rate overall, we're seeing about an 18% increase year over year into 2025 for digital media. For digital experience growth rate, we decided to use Adobe's forecast for Experience Cloud growth, and that's sitting around that 11% range. So our publishing and advertising now seeing about a negative 2.5% decrease over our projections. For our overall EPS growth rates, we're seeing about a 15 to 16% growth rate over the next 5 years. But when comparing this to the previous 3 years, these are much lower numbers, as they've seen 80% EPS growth within some of these past years. So definitely moderate comparative to their recent years. So now we wanted to kind of compare optimistic and pessimistic to our baseline scenario. So for our optimistic EPS, this is where we used our Creative Cloud growth and Document Cloud growth to get these numbers, as well as adding about 10% to our year-over-year returns, year-over-year growth to digital experience segment. The reasoning behind this is that this is a new product offering within Adobe. So we're seeing a lot of new year-over-year growth for them because it's a new offering and new users are coming in. So we wanted to kind of emphasize that. So if that growth keeps up, that's going to be our projections being about 18.6% in 2025. For For pessimistic viewpoint, the main thing we did here was cut our net profit margin to their 5-year low, about 26.44%. In 2022, we expect them to, in our pessimistic scenario, to incur a loss about negative 2.4% for EPS, but then using our growth still about 14.8% overall. All right, so now our PE method estimate. So our baseline PE estimate, we decided to use a 42.2. And then that gives us a $475 per share market valuation for the PE method. And for our discounted cash flow estimates, we're seeing about a $266 per share value using that method. For our combined target pricing, we decided to use a 70% to 30% ratio, 70% into PE. The reasoning behind this is that it gives us more of a accurate market representation to what Adobe is currently trading at now. So for our baseline price, we're seeing about $414 per share, and then $320 per share for our pessimistic, and $524 for our optimistic. With the current price ranging around $397 per share, we do not see a lot of upside within Adobe's current price at the moment. Now Tony is going to be discussing the risks of Adobe.
All right, so looking at Adobe's risks, just trying to stay on the most currently relevant. First off, Russia, Ukraine, we're expecting a $75 million loss from this conflict. But other than that, Russia's such a small market for them that we don't see much impact other than that. But more likely is foreign exchange risk. More than 40% of Adobe's sales come from outside of the US. So with that and the declining European market by 4.1%, we can see foreign exchange risk being a big factor for Adobe. And then next, the looming recession. As we mentioned before, Adobe had a completely different business model in 2008 during the last recession. So their new subscription-based model has not gone through a recession. So it comes with a lot of uncertainty on how they'll perform. And then interest rates and inflation. With that subscription-based model, a lot of businesses rely on Adobe and their products to go about their everyday business practices. So with interest rates increasing, the one thing that we could see is that there won't be new tech consumers and more people purchasing Adobe products. Along with inflation, they have raised their prices since January. And then moving on to the portfolio fit and our partial correlation matrix, you can see on the left-hand side of the screen that there are a lot of moderately correlated stocks with Adobe. Along with this, Apple is one of the most correlated stocks in number 3. And we believe that this may cause some issues in the portfolio when diversifying. Another thing with technology stocks, and I'll talk about it more on the next slide, but we're at about 22.5% for our fund compared to 25.5% in the S&P 500. So we're just about getting over leveraged in technology as well. Growth stocks, though, we can't stress this enough that we believe that we are way overrepresented in the fund, looking at around 47% compared to 40% in the S&P 500. And the policy statement says that we're supposed to be value investors. So we believe that we should be allocating our funds more towards value stocks rather than growth stocks. And finally, to summarize, we are recommending to sell all of our Adobe holdings, which is 30 shares. And you may see on our executive summary that we have changed this from 15 shares. And that's because we've kept a very open mind on what we want to do as we're reevaluating something that's in the fund already. So we didn't know exactly what we were going to do, and we came to a consensus that we believe that it's in our best interest to sell all of these shares. And we bought it at $197, and we're looking at around a total return of 100%. And we believe that this will free up space for other technology stocks. As you can see here, we're at that 22.5% for our portfolio compared to the 25.5% in the S&P 500. Along with this, there's a lot of other less represented sectors that we could allocate our funds towards. And then again, we do believe that the portfolio is over-leveraged in growth stocks. You can see that in the top right with the slow growth, classic growth, and aggressive growth. And then our target price is currently greater than it's greater than our current price right now, but we don't believe that we see enough growth to hold on to Adobe and not try something else and allocate our funds elsewhere. I know that Microsoft and Netflix both pitched to you guys today. Those are two more technology stocks. So if you guys decided to take on one of those, that technology sector will most likely go over that 25.5%. And lastly, this stock may not be reevaluated for another 5, maybe more years. So with all our research and the risks associated in our growth projections, we just don't think that holding on to Adobe is the best call. And that's what we have for you guys. I'll open the floor to you guys for some Q&A.
For questions?
Okay, so I love that you guys went to the Bureau of Labor and Statistics to come up with some sort of a projection for your consumers, but is it just computer employees that use this? Because I think I use Adobe.
Yeah, that's what I was thinking.
You know, I don't know if I pay for it, I'm sure the company does.
I guess it depends on or what is it, I'm losing my mind now. Document cloud is not, it would be more personal on every single computer, but the Premiere Pro, Illustrator, and all those would most likely go to more computer programmers. Those are they also, the video software editors and things like that. That's what that goes to, graphic designers.
So from a revenue perspective, it's not Joe Schmo, it's those
Yes.
folks that are generating, okay. Then the other question is, one of the big selling points for the Microsoft group, and you highlighted that one, was the cloud. This seems like a more pure cloud play if I look at all of your pie charts and stuff. So would this one be the better one if that's where the growth is?
Right, yeah, so cloud here is way different than cloud elsewhere. So I guess cloud here, they kind of label it a cloud, but it's actually just a bunch of different applications. The cloud that Microsoft would be pitching on would be like data storage and stuff like that. So this is completely different. I can understand your misrepresentation of it for sure, because it's got the same name, that's understandable.
Yeah.
But definitely completely two different things. It mostly offers applications rather than data cloud-based services.
Makes no sense.
Cloud, the software is running in the cloud.
Yes.
Yeah,
Correct. So it's not running.
Cloud-based software, Microsoft would host the cloud.
It's on the cloud.
They're running.
All right.
We're converting this to the cloud, right?
Okay, yes. So philosophical questions. You guys came in this semester. How did you decide? So very quickly, how did you decide upon Adobe, and was it coming in with the expectation that we were going to sell it, or what? Or was it like a buy, hold, sell thing?
Yeah, so at the beginning of the year, Dr. Stivers asked us to each kind of pick a stock that we were interested in, whether it was within the fund or outside the fund, that we would like to spend all semester kind of working on. And then one of ours was Adobe. Josh picked Adobe to just kind of analyze in that first assignment. And then Dr. Stivers slowly was pushing us to maybe within the fund.
This is where I thought you were going.
Well, I'm not saying Dr. Stivers told us to do this because he didn't, but
You're not getting drink tickets, by the way.
we analyzed it as a group, and we said this would be kind of our best stock overall, because the other three were kind of maybe a little push.
I understand. The reason I asked that is because we were also pitched, I'm not going to name the stock, but I'll give you the characteristics of the stock, and then we'll compare it to the characteristics of your stock. We were pitched a stock that has a PE around 43, 44, that has expected growth of 5-6%. I'm seeing a stock that has a PE of about 44, but expected growth of 16%. Not telling you which stock to pick is what, but if you're an investor, which
So
one
it's
would
sell.
you choose?
So right now you're saying sell.
No,
Before you're saying buy.
No, I'm saying hold, buy, and don't even think about the other one.
Are you
I got it.
They're going, exactly, but it brings out a good point, right? You don't put names and stuff on it, you're just looking at statistics, and half of what you guys do, and all these people do, is they analyze statistics and you try to come up with some idea. We've been told two totally different stories, but if you look at just those two statistics, here's what we're paying for those earnings, and here's what we're expected those earnings to grow, you can come up with two totally different answers, and we've been trying to get the opposite of what you probably normally would be getting, which I'm not criticizing you guys, because you're doing what you're doing what you think is right, and that's fine. But just kind of interesting.
Yeah.
Again, cocktail product. No real question, but just more philosophical. I'll come up with something. Go ahead, the floor is yours.
You guys started out with a bold statement about the looming recession.
Yes, I would, come on, my cookie would fly out my mouth.
I don't disagree, but tell me more about this recession that's coming. What's, that was you.
It was mine, yes, it was me. Off of, so it was really based off of our two wonderful advisors, personal advisors. I guess, I mean, we've been hearing about the interest rates. So Bob and Brandon, Bob initially said that he's a big more market follower rather than analyst. I'm not trying to throw Bob on the bus. But so,
He's
So-
not giving you your tickets for sure.
so we heeded their advice to start thinking like if this recession is coming, and then I believe Brandon said that what the interest rates were flipped for, was it 10 and 30?
Yeah.
Or was it 2 and 10? The 2 and 10 were flipped. So which is a sign of an incoming recession. So I mean, all the signs that we were given was that this is a true thing, and then it broke down to Adobe's a growth stock, and we're like in recessions, value stocks do better than growth stocks. So I guess that was a real big play on that.
They also have a beta of 1.05, so if a recession comes and the market goes down, Adobe is likely going down.
Good point. So let's play more PM role here versus actual stock analyst role. So beta of 105, you could also look at the other stocks in the portfolio if that's really, you know, you're doing your correlation analysis. You can say, okay, what has the most risk, standard deviation, beta, et cetera, et cetera. As I was looking at this, I was trying to figure out, you said we're overweight growth, and I think this kind of explains where we're going here. So you got these various buckets of aggressive growth, classic growth, slow growth. What bucket does Adobe fit in, do you know, by chance?
It doesn't really,
That is a great question.
Yeah,
That is a great question. We actually did not figure out which one it would fall into.
So- we're doing a lot of hypotheticals and philosophicals tonight. It's Friday. Putting on your PM hat, you think the world's going to hell. You know, the market might fall 5% yesterday. If you were going to, without knowing the names, you know, because we don't know the names, I was right the day after. You're a PM, you decide like, I want to take risk off the portfolio. Which one of those three buckets would you trim? The aggressive growth, the classic growth, the slow growth?
yeah, so I guess I probably.
It's aggressive growth. It is
It's
aggressive.
part of aggressive growth. So while the S&P is probably pretty correlated, and it's about approximately the same. Again, we're a value fund. Even if we're wanting aggressive fund, the S&P doesn't kind of match our characteristics of our fund in whole, I guess. So again, knowing now that it's an aggressive growth stock, it's
You would want to trim aggressive
yeah, we
growth.
want to start
Regardless.
trimming that aggressive growth.
Okay, let me ask this maybe in a different way.
Sure.
If you knew, Phil, you know, hypothetically, aggressive growth has higher beta, classic growth is middle beta, and slow growth is probably a lower beta based on the growth projections, and you thought the world was taking a dump yesterday, what bucket would you still do the same?
Aggressive.
Yeah, I would still say aggressive. Adobe, we've been watching the price within the. We've been looking at the price throughout the days, and you can see that it moves it moves more with the market, or yeah, pretty similar to the market, but we've definitely been seeing when it was down a good amount today, or the S&P was down about 1%, Adobe was down 3%. So while the beta is 1.05, it's still kind of getting hit heavy because it is a tech stock overall. And as we know, tech stocks do get hit harder when the market goes down, due to, or from experience, I guess, from my experience.
Coming back to the recession, so you said early on that made some statement about Adobe and then some other software like Netflix and some other.
Netflix, Hulu, Spotify.
Yeah.
Amazon.
Yeah.
Subscription. Yeah, subscriptions.
Right, okay, so what happens to those, or what has happened to those typically in a recession?
In the most recent, this was from an article that was about COVID, that they did very well, but then there were subscriptions because people have worked those into their everyday,
Okay.
it's almost a utility. Like those four, I guess Amazon would be pushing it, but people use that as their cable, as how they listen to music in the car other than radio. And then, so Adobe would almost fall into the same category, but with businesses, because these digital editing software, or these digital editing companies need this software to run their companies.
Okay.
So I think that it would either hold steady or it most likely holds its.
In a recession, the purchases of consumer subscriptions for software versus corporate purchases of software, who do you think is going to be most exposed to the business cycle? Who's gonna, when you have a decline in sort of GDP, what software percentage wise is gonna fall the most? I mean, like you just described, is that neither one of them falls at all. They're pretty impervious to recession, which is a little hard to buy. Maybe context specific to COVID, but which would you rather hold? Would you rather be selling corporate software? This way, would you personally rather be in the business of selling corporate software? Or, knowing that they're gonna experience a decrease in business and cut things, or would you rather be selling sort of softwares to consumers?
It would be for corporate software.
You'd rather sell that?
Yeah, because businesses are gonna be less exposed to failing than, if someone's cutting their money, businesses are gonna hold on for as long as they can. But like a personal, if they need to buy food, they're gonna cut the Netflix subscription.
Like businesses need these, if they are purchasing these right now, they definitely need them in the future. This is something that you can't really get around, is Adobe is the only one that kind of holds that standard of what they do, I guess, or what products they offer.
Okay, so then my follow-up question would be, is Adobe truly a corporate software or is it personal software? And what would the percentage be?
That's a great question. I don't know if we can use a percentage.
I mean, that Creative Cloud is, it's expensive, so I mean, certainly you think of graphic designers, like you sort of mentioned, being a major source.
Marketing would definitely play a big part in that, and that's a pretty large industry as of now.
But as a software service, it's democratized that access to those tools a lot, right? But I agree, it's probably still more of a corporate audience, for sure.
Especially in the document cloud aspect with the PDF viewers, they actually created PDF, if you guys did not know.
Yeah.
So they have pretty much all market control for that. So that's something to kind of consider, especially in the corporate world.
And again, for single consumers, I think the Creative Cloud subscription is only like $54 a month, so it's definitely reachable for a normal consumer that's just willing to get into graphic design or as a hobby.
Any other questions?
Thanks.
Then move on to the next presentation. Tesla, whenever you're ready. Go ahead. What'd you do?
No,
There you go, you're gonna get that.
alright,
Oh, hold on. Minimize that.
so I mean, I'm still optimistic that I'll be able to spend all of it. That's my goal.
Alright.
Yeah.
Okay.
Good to go?
Yep.
All right, I'm Evan.
I'm Derek.
I'm Max.
I'm Ross.
And today we are going to be talking about Tesla. Here's just a brief outline of our presentation. We'll start with the overview of Tesla's business and their revenue streams, followed by their ESG rating, and then we'll go over some financials. Then we'll get into the key growth drivers, which are electric vehicles and full self-driving software. And we'll talk about some of the risks that they face, our valuation of the company, and then how it fits into the portfolio and what our recommendation is, followed by a short little summary to wrap up. Just a little disclaimer, all of our calculations in this presentation are based on prices as of noon today. So Derek, take it away.
So just a little bit about Tesla's business overall, for those that are not as familiar with Tesla. First, their primary revenue driver is the automotive business. This makes up approximately 88% of their total revenue. Next is Tesla Energy. This is seen with their consumer products like solar roof and Powerwall, as well as more commercial products with the Megapack. Services is Tesla's maintenance centers and facilities like that. And then looking at some of their future growth opportunities could be Tesla Insurance. Tesla right now operates Tesla Insurance in 8 states and is looking to expand to 50 states by the end of this year. Software, this is going to be discussed in depth with full self-driving during one of the growth drivers of the presentation. And then artificial intelligence or artificial general intelligence. This can be seen with Tesla Dojo, which is their supercomputer that trains neural networks for full self-driving. as well as the Tesla bot to amend boring, repetitive, and dangerous tasks in factories. So because of all the opportunities we just discussed, we believe there's a strong growth potential for Tesla with a long-term investment horizon. And because of this, we're suggesting a buy rating. And again, because of these reasons, we do not believe Tesla should be valued as a legacy automaker or a vehicle manufacturer in general, and that it should be valued like a technology company. Soaring EV adoption, combined with Tesla's ability to scale up EV manufacturing, is going to be one of the primary reasons why they're going to be achieve significant profitability in the future. Software development, software usually comes with higher margins than hardware. And because of Tesla's ability, if Tesla is able to sell full self-driving, we believe they're going to reap the benefits from increased margins and profitability with full self-driving. Lastly, Tesla's history of execution can be seen with their two previous master plans, one in 2006 and one in 2016. Both of these have since been completed, and Elon Musk and Tesla have plans to release Master Plan Part 3 later this summer. And so we're excited to see where that plan could take Tesla into the future.
All right, so like Derek said, we are recommending a buy. We recommend buying 10 shares and funding this purchase with cash. Currently, they're at about $870. Our target price for 1 year is $1,112. With this, we're expecting a 28% return in the year. The reason we feel strongly about Tesla is one, their ability to control and cut costs, especially compared to legacy automakers. They're currently demand constrained, so every vehicle produced is already sold, and we see this continuing into the future. And they have the ability to massively expand their production, as they have given guidance where they're expecting 50% year-over-year growth. They still need to navigate macroeconomic headwinds. However, we feel they have set themselves up well to do this in the future. As for some key drivers, one being EV production. Like I said earlier, they have guidance where they're expecting annual production to increase 50% year over year. And FSD development, which although there's not many people in the industry right now doing that, Tesla is ahead of the industry, and we expect them to release this at the end of 2022, like they have said. However, we're not going to include this until 2023 for our EPS valuations. Some risks they have to deal with would be rising commodity and raw material risks, supply chain constraints, and COVID-19 shutdowns. So looking at some key statistics and how they have performed in the past, obviously very high PE ratio. However, we feel their earnings will continue to grow faster than their current price, which will eventually reduce their PE and make it a more reasonable PE. As for ROE and EPS, they have since turning a profit, they have continually growing these two statistics, and this will continue into the future.
All right, so now I'll go over the revenue breakdown to see what segments are increasing and decreasing. The percentages in the table represent the percent of total revenue each segment accounts for. And as you can see, the services and energy segments have been decreasing over the past 3 years, while the automotive has been increasing. This is due to an increase of demand of Tesla cars and the development of new gigafactories. And you can tell by this graph that the revenue in different regions of the world has been increasing over the past couple of years. The other line mostly represents countries in Europe, but they also have a good presence in Australia and in South America. So you notice this large dip in the red line there. That's because they failed to ramp up Model 3. But as you can see with the continuation of the line, they were able to fix this problem. All right, now I'll go over the ESGs, which we have determined is highly favorable. I'll be referring to internal combustion engines as ICE cars. All right, so we'll go over the pros first. The cars are fully powered by electricity, so they release a lot less harmful chemicals into the air than ICE vehicles. Their batteries are designed to outlast the car, and they can reuse 92% of the raw materials. Tesla offers solar technology and energy storage with the product Powerwall. When autopilot is engaged, 0.2 accidents per million miles occurred compared to the US average of 2. Tesla cars have 11 times lower chance for a fire incident than ICE cars. They have 25-star safety ratings, and the board members are required to hold minimum amount of stock, which helps align their actions with the shareholders. Now I'll go over the cons. Elon Musk has been outspoken in the past, and this has hurt the stock price. Tesla cars emit more chemicals when they're being produced than ICE vehicles, but once an ICE vehicle has been on the road for about 5,340 miles, these emissions become equivalent. Another con is that the board members are given option rewards, so this may have them focus on short-term success rather than long-term. Tesla has 3 leadership positions and 8 board members, but only 2 of them are female, so there is a lack of diversity on the board. And the company revolves around rare mineral mining, so this can also be harmful to the environment.
So now to discuss some of Tesla's key financials. We'll get into the PE, but I'm going to start with ROE and ROA. So as you can see, Tesla's ROE and ROA are significantly above industry average and their competitors. This is showing how efficient Tesla is using its assets to generate a profit in its business. Looking at Tesla's net profit margin at 13.04%, this is also significantly above industry average and against their competition like Ford and Volkswagen. It's also worth noting that 13.04% automotive net profit margin is a little bit understated in this table, as of Q1, they did post automotive net margin of approximately 17.5%. Looking at the debt to equity at 0.09, again, this is below industry average and below Volkswagen and Ford. Tesla has approximately $88 million worth of debt on their balance sheet, excluding vehicle financing and energy products, which is very low in the automotive space. Now to address the elephant in the room, Tesla's PE. As of today at noon, Tesla was trading at 120 times earnings. However, we do think it's worth considering their forward PE, as Tesla is a rapidly growing and evolving company. So with this, we annualized Tesla's Q1 EPS, that was $3.22, and we came to a forward PE of around 68. So for a company growing their volumes and their EPS at 50% or better for the foreseeable future, we think that putting a 1.5 to 2x multiple on their growth rate could give a more reasonable PE range for them to trade at. So in that case, if you put a 1.5 to 2 times multiple on Tesla's 50% growth, that could suggest that Tesla should reasonably trade at 75 to 100 PE. Considering that, and considering Tesla's forward PE of 68, we believe Tesla may be undervalued from that metric. Now we'll dive into one of our primary growth drivers, which is going to be EVs. So as we said before, electric vehicles is Tesla's current source of revenue and profit, and they have guided to grow this part of their business at 50% for the foreseeable future each year. This, combined with exponential EV adoption in not only the United States, but the entire world, we believe could bring significant profits to EV automakers, especially Tesla, who is leading the way currently. High average selling prices definitely boost Tesla's margin compared to their competitors, allowing them to make more money each vehicle. And combined with their manufacturing prowess, which can be seen in this picture, definitely allows them to lower costs compared to legacy automakers and improve their margin as well. Just to touch on their manufacturing one more time, this picture is really only 3 parts. It's a structural battery pack and then a front and rear gig casting made from the etcher press that they have specifically worked with. And so really Tesla's only using 3 pieces, which is cutting significant costs when legacy auto would really use around 300 or 400. Lastly, the direct-to-consumer business model totally cuts out the dealership network, which is really costly for legacy automakers. It allows Tesla to be more profitable. So before we dive into the more condensed charts, after each one of these, there's going to be a more detailed chart showing how we got these numbers exactly, and we can certainly go into those in the question and answer section. However, in the base case, we are assuming Tesla is going to grow vehicle production at 45% each year. This is below guidance, which was 50. With an average selling price of $54,000, that is consistent with Tesla's pricing today, with their average selling price being around $54,300, give or take. Looking at their margins now, automotive gross margin coming in at 31.8% definitely seems reasonable. As of Q1, Tesla reported automotive gross margin approximately 33%, including regulatory credits. Looking at automotive net margin at 15.84%, this also seems reasonable, given that Tesla also just posted automotive net margin of around 17.5%. Although their Q1 numbers seem high, these are reasonable assumptions in the base case, as Tesla may face troubles ramping 2 factories at the same time. With that being said, EPS attributable from EV growth came out to $11.23. So again, this is just a more detailed chart. If there are questions about those assumptions, we can go through them during the question and answer. So then discussing the pessimistic case, in this case, we have Tesla growing vehicle production at approximately 40% year over year. This is well below guidance, which is 50% for the foreseeable future. Average selling price in the pessimistic case is forecasted to be $50,000, which is lower than their average selling price today. The reason being this is lower is in this pessimistic case, we are assuming Tesla is facing increased demand pressures and are forced to lower costs to remain competitive and to keep their demand strong. Now looking at margins, in the pessimistic case, Tesla at 30.8% is well below their 33% they posted in Q1, although still very strong for the sector as a whole. Automotive net margin at 13.09% is significantly less than it did today. However, increases in research and development and selling general and administrative expenses contribute to the decline in margin as well. With that being said, we are forecasting Tesla to post $8.03 EPS in the pessimistic case. Now, lastly, the optimistic case. In this case, we're forecasting Tesla to grow vehicle production by 50%, essentially meeting guidance for the foreseeable future. Average selling price is raised to $57,000. The reason being this is raised is because last year Tesla had been forced to introduce multiple pricing hikes between $500 for lower trim models up to $5,000 for Model S and X. So with that being said, $54,000 in the base case to $57,000 in the optimistic case is assuming 2 rate hikes of $1,500, which is consistent with Tesla's previous rate hikes. Because of the increase in vehicles produced and the increase in average selling price, margins are going to be better than in the base case, being 32.30% and 17.75% in the optimistic case. 32.30% gross margin is still below what they posted today. However, that is with regulatory credits. The automotive net margin of 17.75% is roughly on par with what they posted in Q1. With that being said, we have EPS attributable to EV growth of approximately $13.74.
Okay, so the next key growth driver for Tesla is their full self-driving or FSD software. You've probably heard of it. It's the autopilot that everybody loves. It's currently not widely available, but there are over 100,000 cars currently using the beta edition of the software. They're primarily gathering data for the full rollout by the end of this year. As I said, they're projecting the full rollout to be the end of this year, but we use 2023 in order to remain conservative in our estimates for the rollout of the software. The take rate that we use is the number of customers that will purchase the feature with their Teslas, and we started with a conservative estimate of 30% by 2025 in our base case. And then this is following steady increases each year after the 2023 release. So this is the FSD growth base case of our scenario analysis. You can see the Tesla vehicles sold is based on our EV growth charts. The price is $12,000, held constant throughout all 3 scenarios. This was established by Tesla already. The take rate, as I said earlier, we used a conservative estimate in our base case of 30% take rate by the end of 2025. And the profit margin here is 47%. This yields an EPS attributable to FSD of $6.77 by 2025. In the pessimistic case, the prices remain the same. Vehicle production numbers have changed in accordance with our EV growth numbers, and the take rate has been reduced to just 7% through 2025. With the also reduced profit margin of 42%, this yields an EPS attributable to the software of $1.23 by 2025. And in the optimistic case, the price again is held constant, but the take rate is increased to 40% by 2025. With an increased profit margin to 52%, we see EPS attributable to the software of $11.44 by 2025. Now that we've talked about some of Tesla's key growth drivers, it's also important to talk about some risks that they face. One of those risks is obtaining rare earth elements, for example, neodymium, which is an element that's found in the magnets that power the EV batteries. China currently controls 90% of the world's neodymium supply, but Tesla does have long-term supply contracts already established with many suppliers, and they have anticipated rising supply costs in the future and have priced accordingly for any future increases. Now I'll let Max talk a little bit more about the macroeconomic pressures that Tesla might face.
Yeah, so we'll kind of cover 3 pressures that Tesla might face and how they set themselves up to minimize these risks. So first, starting with inflation, they've basically been able to proactively increase prices 6 to 12 months in advance. Not only does this help inform the consumers, but it also helps control costs for Tesla, so nothing comes out of left field necessarily. Rising interest rates. Tesla currently holds about $18 billion in cash and has minimal debt. So should they need to expand, we believe they can fund this however they would like to. If they want to go loans, they can. Otherwise, they should be able to fund it. And then GDP decline in Q1. Currently, like I said earlier, Tesla's got a backlog of orders. So at current production rates, everything being produced is already sold. And we think it's going to continue well into 2023, where hopefully the GDP will rebound.
All right, now I'll cover a couple more risks. The first one I'd like to go over is Elon Musk's behavior. Like I said before, he's been outspoken in the past, and this has hurt the stock price. And we expect this to happen again in the future. He's also very busy with his other companies such as SpaceX, Neuralink, his Boring company, and now Twitter. This may cause him to put less attention to Tesla or even leave, which may cause consumers and investors to have less faith in the company. Next risk I'll talk about is increasing competition. A lot of auto manufacturers are coming out with their own electric vehicles and their own autopilot features, so this will certainly cut into Tesla's revenue. Lastly, I'll talk about the effect a recession will have on Tesla. Since Tesla cars are more expensive than the average electronic vehicle, if a recession hits, consumers are more likely to go to a cheaper alternative, thus hurting Tesla's revenue.
All right, so kind of bringing everything all together now with our valuation. We'll start with our base case. So something to note, when we got to our total EPS, we only included automotive revenue and FSD revenue. Although currently they do have revenue from service and energy, we decided not to focus on these. 1, to be conservative with our EPS, and 2, we believe FSD and automotive will be the large growth of Tesla and what Tesla will look like in the future. So something to note right away, we have a large increase for automotive growth in 2022, and this is mainly seen to them ramping production back up following COVID. And we see this growth rate increasing at a decreasing rate until 2025, where we'll have automotive revenue being about 89% of the total EPS. For FSD, we kind of see this acting opposite as automotive. We think it's going to start pretty small with the opportunity to really get blown open through 2025. And this is mainly because it's a new tech and there might be some public concerns regarding FSD and its safety. But once we feel once the public feels comfortable with the FSD, it could really explode. As for our total EPS, it just follows the trends of both FSD and automotive. So now we're going to look at the EPS scenario, break it broke down by each scenario. With our baseline scenario, as you can see, by 2025, we think it'll be up to around $60 per share, or earnings per share. Optimistically, we think this could end up at $87, and pessimistically, we still see growth ending up around $31. So for our one-year target price models, so in order to find our target valuation, we decided to use both the PE and the discounted cash flow method, weighing each 50-50 basically. And by doing this, it was because we had such wide range of values from our PE numbers and our discounted cash flow numbers. So for finding our PE valuation, we decided to estimate a PE value of 130, which is what Tesla's been trading at around this week. And by doing this, we see a baseline target price of $1,112 with a target return of 28%. Pessimistically, we still see a positive target return of 6%, aiming at a target price of about $920. And optimistically, we can see returns just under 50% with a target price of $1,277.
All right, now I'll go over the portfolio fit. If you look at the correlation matrix on the left, you can see that Tesla has less than a 50% correlation with all the stocks in the Spellman fund, which is good. It's most correlated with Apple, Adobe, Turtle Beach. And one important correlation I'd like to point out is GM on the bottom there at 33%. So we're not too worried about having both of these auto manufacturers in the portfolio. It is least correlated with Google, Pfizer, CVS, and Qualcomm. Tesla has an efficient weight of 1.9%. We propose a weight of 2.23% because we expect a 28% return. After the purchase of Tesla, the consumer cyclical sector will have a weight of 7.81%, while the S&P sits at 12.29%, so we are not overweight in that sector. And the auto industry will have a weight of 4.28% in the portfolio, while the S&P sits at 4.8. So we're also not overweight in the industry.
All right, to kind of wrap everything up, we recommend the purchase of 10 shares using cash. We see high growth potential in Tesla, not only in the automotive industry, but also with FSD, which could really explode after 2025. And should you guys decide to purchase Tesla, you should expect returns of about 28% in the first year with our baseline case. However, pessimistically, we still see a return of 6% by next year. Thank you guys, and we're ready for questions.
So I'll start us off. So we were supposed to go till 5:20, but we started 5 minutes late, so we could go a few minutes past 5:20. So I want to play the role of Kevin Spellman, who couldn't make it today, but we're recording, so he may be watching this later. So go to your financials slide. Yeah, so I think what Kevin Spellman would probably say is Tesla is at a 120 PE while Ford is at about 5. So Tesla is 24 times more expensive than Ford. So if you would ask, would you rather have 1 share of Tesla or 24 shares of Ford? Or also, do you think Tesla will grow 24 times faster than Ford to make
So,
up for that PE?
so what we would say is we wouldn't value Tesla like a legacy automaker like Ford or Volkswagen. So we wouldn't expect Tesla to have a PE that low. We think that Tesla should be valued more of like Apple or more of like Amazon, trading with a PE ultimately of around 30 to 50. So with that, if you look at our 2023 EPS estimates and you annualize that, or if you look at our 2023 EPS estimates and look at the forward PE from that gets you around the 45 mark. So because of those reasons and because of Tesla's 50% growth, we think that a larger PE is justified for Tesla.
What's the addressable market? How many, is this a luxury car?
So Tesla right now is considered a luxury sedan, yeah.
How many luxury cars are sold globally?
So we don't know how many luxury cars, we didn't find that in our research, but we do know that the total vehicle production and vehicles sold are around 85 million. So Tesla last year sold 1 million vehicles in that segment, and they sold every vehicle they made. So they're around 1.25% of the global market share. So while we think that EVs are EV adoption is growing, Tesla's market share will decrease as more competition comes. However, Tesla is still selling every vehicle it makes, and we foresee that into the future. Tesla is guiding for 50% growth, and they have more knowledge on their demand that is publicly available. And so we believe that them growing at 50% is considering that they will sell those vehicles.
So let's fast forward 5 years. You've got a 5 million automobiles sold. What do you think their market share will be in the luxury auto market? 10% of the market, 20% of the market, 30% of the market, 50% of the market, 80% of the market? For every 10 luxury cars on the road, how many are gonna be Teslas?
In the luxury auto market, I think that's really hard to say, and we don't know for sure yet, obviously. The way that the world is starting to adopt electric vehicles, I think that might be more of an important factor than the fact that they're considered luxury cars. You also see that Tesla is hoping to release models that are priced cheaper in the future, so they may not be considered as luxury. And I think that's going to be really important as well if that ends up being what their master plan part 3 is. You never know. They tend to keep their master plans pretty secretive until they release them and then tell everybody what they're doing. So I think if they can find a way to price them more affordably, and the world is shifting more towards electric vehicles because of things that the government is doing and more like socially responsible just vehicle production in general, then I think Tesla would see not an increase in the market share, but an increase in volume still, because so many more people are buying electric vehicles.
Because you've got it in there that they're gonna be about 60% of the luxury auto market in 5 years. Which seemed a little high, but then you came back and said they're gonna come up with lower priced units. Are the lower priced units gonna be high margin vehicles, low margin vehicles? And doesn't that affect our margin assumptions?
So the vehicle that they're currently in development as of the last call is going to be a dedicated robo-taxi. They did away with the idea of the $25,000 Tesla that was speculated on by the street. So with this vehicle, we do believe this vehicle will have pretty high margin because it's going to be dedicated to their full self-driving software. This also instills confidence in our projections for having FSD even be achievable because they're working on this car, so they must have confidence in the organization that they're going to be able to solve that. And with the car ultimately operating on full self-driving, it'll have pretty good margins, I think.
Yeah, so what kind of infrastructure do you need in order to get those kind of sales? For instance, right now in California, you wait getting a charge. It's busy.
So yeah,
We have material problems too. They do have some contracts, but if they're in China, those contracts are only as good as the paper they're written on. They're not much better. Sorry. So I mean, don't you think there could be some limits because you have to be able to charge these cars?
I think Tesla has well in advance planned this. They've been building out their supercharging network for years now. So they've known that they wanted to grow to these volumes, so they built out supercharger network and they're continuing to do so. There are certain places like in the Bay Area where supercharging and Teslas are common and they're congested. However, they're combating that by continuing to ramp the supercharger build out as we go into the years.
And another thing, you were talking about how materials, especially rare earth elements, are kind of problematic when it comes to supply. If you look at this chart, or this map, I should say, this neodymium that I was talking about earlier, it's not mined in the same way that copper and lithium and these other rare earth elements are. It's more of a substitute for them, so it's actually much easier to obtain, which is why a lot of these new batteries that Tesla's making are switching to this magnet-powered, neodymium-powered magnet used in the battery. So that could alleviate some of the stress on.
My understanding is there's a lot of lithium in the earth. It just takes 5 to 10 years to get it out and people willing to make the big holes that it takes.
And one last thing on the rare earth elements part is Tesla has multiple form factors for their vehicles, considering battery cells. They do have the lithium iron phosphate, and then they do also have nickel in a different form factor of their batteries. They have the original 2170s, and then they just built the 4680s that are more leaning towards nickel. So they have a variety of different elements they can use if they run into a problem with one.
If you go to the full service driving slides here.
Start here, or did you want me to go to the chart?
You can start here. So it's $12,000 more per vehicle that somebody would have to pay to have this software.
Yes, the price here.
Okay, so do you guys, camera's still wrapping out about not driving my car, but anyways, 2023 is pretty quick. 8 months is 2023. And we have profitability on this software in 2023. What's this beta testing like as far as results, like the confidence that society is going to have? Like you talk about, you got the luxury car market buyers, which is a small percentage of the population. But then you got to look at those buyers and say, how many of those people want to pay $12,000 for this software that they may not trust? So if they don't trust it, they're not going to pay 12 grand. I mean, you got to have a lot of confidence in this software to pay 12 grand for it. It's your life, right? I mean, that's quick. So talk about like how confident Tesla is to really get that many people to buy the software next year.
I can touch on that. So they've been building out this beta program now for a year. They started with a couple thousand. They've now built it out to 100,000. What that's doing is the car is collecting data, which goes into the Tesla Dojo, which is their supercomputer, and it's training the full self-driving neural network from real world data, increasingly making it better as they drive more miles. So Tesla is by far the leader in miles driven, collecting this data. No one's even close, not Waymo, not anyone. So they have data others don't. And they're expecting this to be better than a human by the end of 2022. And it's going to increasingly get better, and it's going to have to, like you said, it's your life. So they want it to get at least 10 times as safe as a human, and then they're going to bring it to regulators to bring the wide release.
Are these being tested in like high volume traffic areas?
These are being
with,
tested,
like-
these are being tested all over the United States. You can go on YouTube and you can watch Tesla navigate intercity Milwaukee, or Tesla's intercity Milwaukee. On winter? Yeah. Rob Mauer made a YouTube video of him driving on Brady Street and Water Street in Milwaukee, going through construction, having minimal issues, and it's a lane beta. Brady Street on a Friday night. I don't know if it was a Friday.
Can you speak to how long they've been promising full self-driving, and the price increases they've done over the years?
I can, yeah. So, full self-driving the price did increase around a year ago from 10,000 to 12,000. They have been promising full self-driving capabilities for quite some time now. However, they've never released a beta program while still promising the beta. And so I think that the beta is a really good sign that they're very confident that they're going to solve this problem. Additionally, working on a dedicated robotaxi, I think, is another sign that they're really confident that they're close to solving this problem. It's a really difficult problem to solve. I think Tesla has the top talent to do it, if anyone can do it.
So, but I mean, I think they've been selling it since 2018.
They have.
And have people waiting for it, because they're 4 years behind. So I don't know how much I trust that it'll be ready in 2 more years. The next thing is, can you speak on any of the pending litigations against Tesla and Elon Musk in terms of SEC type stuff that might spook shareholders and thus the stockholders?
I can. So yes, when he did buy Twitter, he didn't necessarily disclose it in a timely manner, is what that one allegation is alleging. I don't know if that's the one that you're
Well, I
necessarily
mean, just
talking about.
the litany of lawsuits. There's people who prepaid for full self-driving who are now have class action suit against Tesla for the price increase, the failure to deliver, and so forth. So, are there any risks or litigation from some of the full self-driving accidents where people have died from it because the vehicle did not recognize what was in the road?
Not yet, no. But if you think about it, everyone's gonna throw the flag if Tesla has a full self-driving crash when millions of people are killed in vehicles every year. That's just how it's gonna work in the media, and we know that. So that could create a buying opportunity if Tesla's getting negative press about their software for that reason, even if data is showing that it's safer than a human driver. You know, it's a new technology. People are gonna throw the flag if that happens, and we're prepared for that.
Go ahead.
All right, good afternoon, Spellman Board. We'd like to present Alibaba. My name's Eli. I'm Michael.
I'm Sam.
Johnny.
First, we'll give a brief outline. We'll first go into our recommendation for what we believe we should do, followed by our business overview, key financials, key growth drivers, valuation, portfolio fit, risk, followed by our closing summary.
All right, so for the recommendation, we're recommending that we buy 100 shares of Alibaba. We believe that it's currently undervalued due to the regulatory uncertainty in China. One thing we really want to highlight is the pessimistic scenario valuation is higher than the current price. This is showing an upside of around 16%. We're going to talk a little bit more about that. The forward PE using our 2022 baseline is 10.18. With Alibaba, a lot of people are focused on their e-commerce and have talked about how it's slowing down. We're going to talk about why this is happening and that there's still a growth story to the stock, even with this cheap valuation, with the cloud computing and the international e-commerce segment. And then another thing we want to highlight is Alibaba's and Amazon's free cash flow. Both of them are very similar, around 25 billion, but the market capitalization of Amazon is about 1.2 trillion, where Alibaba's is around 250 billion. So the question we want to ask is Amazon's free cash flow worth 4.5 times more than Alibaba's? Our group believes that it's not, and this is why we believe it's undervalued. And lastly, there's a lot of risk that comes with Alibaba, but we believe that the reward is worth more than the risk.
Okay, yeah, so just to hit on a few key metrics here, the first one that we're gonna keep harping on, obviously throughout the entire presentation, is the PE, currently 10.92, which Obviously for a technology company of that size and reach is very low, and we believe it should be priced a lot higher. EPS also increasing over the past couple of years. And then if you look at the 5-year stock range chart, you can just see that, from May 2020 to today, it's slid from just over $300 all the way down to today's price of about $90. So we believe it's very undervalued for many of the reasons why. So just to look a little bit more at the business in general and what Alibaba does. So you can see from 2020 to 2021 as a percentage of their total revenue, their China commerce decreased from 80% of their entire business to now around 70%, which we actually see as a good thing because that means these other segments that we think are going to be the growth drivers in the future are actually starting to gain some of that share of their business. So a couple that we're going to talk about, one is cloud computing. As you can see from 2020 to 2021, it didn't take that much more of the entire revenue or business segment. But we believe going forward, it's going to keep growing, especially because it just reached profitability for the first time in 2021. And then also other, that's comprised of a lot of other companies that you'll see on the next slide. But the main driver there to get it from 5% to 15% is Kaniao, which is their new shipping and logistics arm. So yeah, speaking of, their different businesses, we really wanted to highlight the ecosystem. They really see themselves with a spawning mentality. Obviously, there's a bunch of different companies under Alibaba as a whole. So you have the retail commerce, and that's kind of the classic companies that you would think of with Alibaba, like AliExpress, Taobao. But they really want to become kind of a one-stop shop for commerce, not only in China, but throughout the world. They have Ant Group to provide the payment after a purchase, and then Kaniao, which we're going to talk about more, is the logistics infrastructure company that provides all of the shipping for Alibaba, as well as for third-party companies as well. And they're looking to provide 72-hour free shipping anywhere in the world. So we see Kaniao and obviously Alibaba Cloud, which we'll talk about more, being key businesses that are going to drive growth in the future, other than the main retail commerce companies that you would think of now.
So looking at some ESG elements, first the pros. They released their first carbon neutrality report in 2021. This basically stated that they wanted to reduce their carbon footprint and lower emissions by 2030 to be carbon neutral. They've also increased their corporate responsibilities. Alibaba has invested $15 billion into reducing China's wealth gap, which is very high. And some of their cons are predatory pricing. In the past, they've gotten into some legal issues with predatory pricing the product. By controlling a lot of market share, you'll see this, happen. And then also the board lacks diversification. With only 5 insiders and 5 outsiders, we believe that they could be more diverse with their board.
All right, so to talk about the financials, we're going to just spend most of our time comparing this to Amazon, which Alibaba is most compared to. So the first thing we want to talk about is the PE. Compared to Amazon, Alibaba trades at about a 10.92, and Amazon's around 38.35. And we know that Amazon may still be overvalued. Even after this, you can see that Alibaba still is undervalued. Another area we want to harp on is the price to book. Amazon trades at a price to book around 9. Alibaba is about 1.83. And lastly, we want to talk about how strong Alibaba's balance sheet is. So their debt to equity is 0.45. They have around 50 billion in cash still on top of their 25 for share buybacks. So they've talked a lot about how much cash they have for future investments. Amazon has a higher debt to equity with more debt on their books. So Alibaba has a really strong balance sheet.
This is the exchange rate we use to convert Chinese yuan to US dollars.
So our first growth driver is cloud computing. Currently, Alibaba holds 30% of the market share in China, and they provide cloud service to external businesses as well as Baba's own e-commerce system. Profitability will increase with economies of scale, and total cloud computing market is expected to grow to 155 billion by 2025, which is almost twice the rate of the US year over year. So for our first pessimistic scenario, we use China's 5% GDP growth rate times the US mirror. The US mirror, we had the US cloud revenue is currently 3 times the cloud revenue of the China. And China has a high cloud growth rate. So we use cloud revenue as a percent of total GDP, as you can see here. And then we factor that out to get the year-over-year growth rate. So we did the China's 5% times the year-over-year growth rate to get the pessimistic scenario. Next, for the optimistic scenario, we based it on Alibaba's Q3 presentation, where they said by 2025, there'd be 155 billion in cloud revenue in the total market. So using a 38% market share, they have 58.9 billion by 2025. So that's 50.5 year over year. And then for the baseline, we just used an average of the pessimistic and optimistic scenarios. Next, our next growth driver is e-commerce, which makes up international commerce and China's commerce. In China, overall, they have 1.24 billion users and 943 million are in China. So we feel they've reached potentially all their consumer base as China has a 1.4 billion population. Next, they operate in 190 countries while Amazon only operates in 13. So with some future growth goals are expanding to expand their international business, obviously, and then offering free 72-hour shipping anywhere in the world. So for the China commerce, we use a baseline, for the baseline scenario, we use a 5% growth rate as that's the GDP growth rate in China. Next, for the pessimistic scenario, we want to be very conservative and use a 0% growth rate as we feel they've reached all their consumer base in China. And lastly, for the optimistic scenario, we use a 7% growth rate as this is the last 3 quarters growth rate. For the international commerce, for the pessimistic scenario, we had a 3.82% growth rate as according to the PwC, world GDP is supposed to grow by 130% in the next 34 years. For the optimistic scenario, we had it growing by 18% for year 1, which is the last quarter's growth rate, and then increasing at a decreasing rate of 2%. So at 2025, it'd be at 10%, and we feel that will continue the growth rate from there on after. And lastly, for the baseline, we had an average of the pessimistic and optimistic scenarios.
To look at our valuation, we'll first look at the baseline EPS projections. As you can see, our biggest growth observation in the future would be the cloud computing. We also see that our other EPS will start to increase as other companies become more profitable. And then here are the growth rate projections. As you can see, cloud computing leading there, with other EPS also growing.
Yeah, and then, so just based off the scenarios we just talked about for pessimistic and optimistic, these were the EPS estimates we came up with using those strategies.
Okay, so for the valuation, throughout the entire process, we wanted to remain conservative. And we believe that the EPS or the PE ratios that we use here are very conservative. The pessimistic scenario, we used a 14, baseline of 16, and a 20 PE for optimistic. And the one thing we want to talk about, the current price that we used at 12 o'clock was $91.20. Even using the pessimistic scenario of a 14 PE, we're still getting a share price of $102. And then same thing for the discounted cash flow. We wanted to use a 60% PE because it was giving us a more conservative outlook. So with a baseline of $156.44, we're seeing about a 71% return. And even with the pessimistic, which is 0% growth in the core commerce and low growth rates and low profit margins for the cloud, we're still getting a scenario where we're getting $105.85 at the current price of $91.20. So we're still seeing about a 17% upside. And we think that it's very unlikely that the core commerce will grow at 0% and the cloud will grow at low revenue numbers. And also we want to talk about the share buyback program. So Alibaba had a share buyback program about $15 billion. A couple of months ago, they just increased this to $25 billion, given their strong balance sheet. We agree with this because they're purchasing underneath the pessimistic scenario. So management's returning value to their shareholders. And the CFO actually made this remark in the Q3 call that I thought was very insightful, that our current share price does not fairly reflect the value of the company. At these current prices, we plan on continuing our share repurchases. And we agree with this and continue. If the share price continues at this price, we could definitely see them purchasing more shares.
Now to talk about the portfolio fit. The average correlation to the fund is 0.287. We believe this would be a great idea to help diversify the fund, as international is very underweight within the fund. It would also be the only Chinese stock in the fund. And so that brings us to our overall recommendation of, we think we should buy 100 shares.
Yeah, so just to get into the risks here, which I'm sure we're gonna spend a lot of time on. The first one we wanted to talk a little bit more about here is the audit risk. So, you know, a lot of articles and a lot of the fears around Alibaba is pertaining to audit risk. There was actually a meeting in China today. US auditors were over there trying to reach a deal that would allow the United States firms to come in and audit Alibaba, as well as a lot of other you know, publicly listed Chinese companies, which obviously we're hoping they are able to reach a deal. We wanted to highlight the fact that throughout all of their earnings calls, the CEO and other executives are very willing to reach a deal. They're currently audited by PwC, and their CEO has also said that they're following GAAP standards. And you know, I guess, although yes, there's no way to know that 100% right now. They're open to reaching a deal. The Chinese government has also stated that they want to work with the US in, you know, getting these things cleared up. So we put it a little bit lower on the probability of the risk, just because we haven't seen any issues with it yet. So we think, you know, hopefully a deal is reached where they can get audited, and then this fear can completely go away.
Yeah, and the next fear we want to talk about that it's mentioned probably the most is delisting fear. We believe that this risk is overblown. This doesn't really affect the overall business. It doesn't change the cloud. It doesn't change the overall earnings. The main thing that it changes is the amount of equity that comes into the market. We believe that it's came out many times where the Chinese government said that they don't want their shares to be delisted because they want to be able to be on the NASDAQ and have the best stock market where the most money is flowing to. So if this does get delisted, I know from multiple brokerage accounts, TD Ameritrade, Charles Schwab, what's the last one? Yeah, Fidelity. They've talked about how if it does get delisted, it will just go over the counter and they'll allow you to transfer your shares to Hong Kong. If this is a major issue, we can just buy the Hong Kong shares and get rid of this delisting fear, and then you pay to 2 or 3% fee for the interest. But our biggest political risk is on the top right. It's just like overall political risk with the government. An example of this would be like the anti-IPO being canceled suddenly. I think the biggest risk would be if the government finds that the cloud computing is sensitive driven and the data has to be controlled by the government, and they would make Alibaba Cloud go to be a state-owned entity. The CEO's talked about that he doesn't think this will happen, but it is a risk that is definitely potentially there. There is state-owned cloud computing companies that have been successful, and this may happen. But overall, we think that the risks are overblown for Alibaba. I mean, everyone's putting the most pessimistic scenarios on this, and they are not putting any weight that management will be able to deal with these risks and work around them. Yeah, so the closing summary here, the main thing we want to harp is that we believe that the potential for outsized returns outweighs the risks. There's a lot of short-term noise with this stock. I mean, 2 days ago, someone under the last name named Ma was arrested and the stock fell 5%, even though Jack Ma is not the CEO of Alibaba anymore. And the person that was arrested was not Jack Ma. It was just some random guy with the last name Ma. And the stock falls 5%. So there's a lot of noise. Every day the stock seems to go down, even like if an intern's fired at Alibaba, the stock goes down 2%. But we want to remain that we were very conservative with all our estimates, and that this is a long-term 5 to 10 year outlook. Like if you believe that Alibaba will be a bigger and better company in 5 to 10 years, which we do, and our research shows, then this is a buy. Because of the two major growth opportunities too that I think a lot of people are overlooking is expanding into the international e-commerce market. The CEOs talked a lot how their main focus over the last 3 years has been the core commerce. And over the next 5 years, their main focus is going to be driving the international e-commerce and the cloud computing. We've seen cloud computing, how excellent it's done for, let's say, Azure with Microsoft, AWS for Amazon. We know that a majority of Amazon's operating income is driven through this cloud computing. So this has a huge opportunity for Alibaba. And lastly, we just want to talk about the PE being 10.92 and that our pessimistic scenario is still underneath the current, or is over the current price, and that it's a 71% return. That's all. Thank you. So we're open to questions. Shoot.
About 15 minutes of questions.
Can you go to your, I guess you kind of break down the earnings growth, go back a couple slides. Stop there, go back one more, forward. Nope, forward one more, there we go. Nope, the little 72 is up in the upper right hand corner. There we go, stop this one, sorry, EPS. So you have your two growth drivers. I guess I'm confused, this one threw me off here because I was start looking at your cloud EPS and then looking at the e-commerce, which cloud's growing very quickly, but it's still a pretty small percentage of the overall pie, right?
Correct.
So I guess at what point does that really drive Alibaba? That's kind of my first question. And the second, am I reading that correctly in that the other EPS is all losses?
Yeah.
Okay.
Yeah. So
Can you speak to that a little bit? Because I maybe I missed that one over
you
my head.
want to do the cloud?
Yeah.
I don't know.
I mean, the first part regarding the cloud, we think, you know, it just reached profitability in like Q2 of 2021. And as we know with like cloud infrastructure, the startup costs are massive, but once it's in place, acquiring new customers doesn't cost anything. So we think that like the economies of scale is gonna, although, you know, right now it's a small portion of the business, we think that's gonna grow really fast just because of the nature of cloud computing. And
Yeah, and just to add on that too, the CEO and the CFO talks a lot in the earnings call about how far behind China actually is in their digitalization and cloud computing. And they've talked about how the cloud computing can help a lot of companies and that they're seeing that this is where it's going to be going, that they can improve their businesses, they can improve storing data and stuff like that. And we see that the profit margin should be increasing well because it's going to be, the fixed costs will be shared across more customers. So that's why we see the EPS growing so much.
And then maybe I missed this too, or you probably went over Tyler's head. Is Microsoft and Amazon allowed to compete?
Yeah. So the three main competitors, actually wrote one of them down because it's hard to pronounce. It's Huawei Cloud and then Tencent Cloud. So Tencent is the biggest competitor, but Amazon or the Chinese government will not allow any other companies. They want to keep it within the term. And then the state-owned entities.
And then is it the same situation with them with the cloud? I mean, what I'm trying to get is like, what's the competitive dynamics within China with the cloud? Because Tencent's
4 competitors have like 96% of the market, so it's a very high percentage, and it's really the main 3.
Yeah, I think there's a scenario where all businesses will probably do extremely well. It's very fun. I mean, you see with ads.
So it's not like Tencent owns 90% of the market right now, and
Alibaba has 38%.
Alibaba has 38.
okay, that's what I was got. I meant.
Yeah, it was. Yeah. And then for the other EPS just going down, Cameo is really close to reaching profitability. They said probably by the next quarter. So hopefully in this Q4 quarter, they'll talk about Cameo being profitable. And then just they talked about how many companies were under the wing. They didn't necessarily say which ones are very close to profitability. Maybe if you go to that slide where you have all those other. Yeah. So
the reason the other is negative is because there are so many.
Yeah, so I think the whole point is that they're willing to take losses on all these.
Yeah.
And that they can, like, so for like example, Yahoo is like YouTube of China. They're probably not going to reach profitability of that, but it's more like the fact that they're willing to build the brand and always be something. So you would use the Alipay for that, and then you would watch Yahoo for your YouTube, and then use Cameo for shipping. And they're just trying to build the whole ecosystem.
I'll say 5 seconds as I was looking at this, and we go down rabbit holes, which we're not going to do. But as I was looking at this, and I think of all the other China companies, I just think of them as big conglomerates. And then you start getting into the sum of the parts valuation and how we can value this business at this and this and this. If you add them all together, it's like 7 times what it's worth. And we know from history that never ends up.
Did you guys do that? Did you value each of these?
That's what we just took the top 2.
Again, we've been on.
Did you do that?
Spellman wanted us to break it down. We felt that might be a little bit too much with all 50 of them, but yeah.
Did you guys lose your internet connection when we told you to do that?
But earlier you mentioned share buybacks as
as part of the structure. Can you help me understand where's the cash coming from the buyback of those shares? Are they recapitalizing their balance sheet? Is this from free cash flow? How exactly?
I think they said it was a mix of free cash flow and just cash on hand on the balance sheet. Cause they had about, with the initial, so once they added on top of the 25 billion, they had about 50, they still had 50 billion in cash on hand.
So that there's, it's not a recapitalization.
No.
So we don't have a debt situation
No.
going in this.
They have enough, they have enough cash on hand to pay off all their total liabilities. So they have a very strong balance sheet.
I have just a comment on how you presented some of the data, couple of the growth slides, you know, there's a lot of data on there. It's hard for, you know, us to sit here and read it and you skip through it very quickly. Either make up like a single point and like point us to where you want us to pay attention, or just don't present it at all. When you go through that quick, it kind of doesn't really help. So just kind of some advice for when you're doing something like this, you know, less is better on the slide. I know it's hard in this format to do less, but if you're not gonna really spend time, you're just gonna skip through it, then just go ahead and skip it, and we can always have it in the back and you can address it if a question comes up.
Oh, yeah, thanks.
I did make a note that I liked this, the thought process behind this slide. And saying, all right, what's the US cloud as a percentage of GDP? Could China get to that same level? And what would the growth rates be? So I like the logic behind it. And then I liked it a lot less when I got to the earnings per share slide and realized it's, you know, this is a really good analysis of a very small part of the business. I understand it's a growth opportunity for the company, but it just seemed like the e-commerce part was a more, you know, significant portion of the business that I felt maybe more time could have been, you know, spent on the fact that it is. And it is true, like the Amazon of China, given its breakdown, just, you know, took a while for Amazon's cloud business to become as big as it is. So yeah, could this be? And maybe we were not aggressive enough in our cloud forecasts.
We were trying to be very conservative.
Yeah.
So I agree with your comment about Ant. That was obviously a big negative to Baba when they weren't able to spend that off. Do you guys know what does Ant contribute to Baba's financials, EPS revenue? Were you able to?
No.
Yeah, I couldn't
we
find
do
that
not
either.
know.
Okay, I was wondering.
I think it's private.
I wonder if you guys maybe could do the work for me. I couldn't find it either.
No, but it's privately owned. They barely talk about it. We talk a lot about how many users use Alipay and how it's replacing credit cards and stuff like that. But no, off the top line, we're not giving that information. I know in the past, so there's been tons of valuations on.
Oh, huge billions.
Yeah, it was.
Still.
Along the lines of the buyback, did Spellman have you try to figure out how much that would contribute to EPS? Have you run through that?
No.
Okay, I was just curious.
We, in our forecast, we estimated how much they could buy back off the value line too. But no, we don't know that how much that's gonna contribute, but it definitely.
Would lower your share count.
Yes, more slice of the pie.
Yeah.
Yep.
Other questions?
I think everybody can hungry. Alright,